All right. Good morning, everybody. So we finally got the Fed out of the way. We've got Microsoft out of the way and Tesla out of the way. The only thing left is Apple. The market is pricing in a very extreme move for the next 2 days. And we're going to get to that. I'm going to show you how to be able to see that. But let's just start where we normally would start. Look at the FX Street. This is where we can see the calendar of events for today and get a little bit of a perspective on the dollar. You don't have to sign in. In fact, I highly encourage you to not give these guys your email unless it's a junk email, because they will harass you and bombard you with emails just constant, nonstop. If you don't like somebody, maybe give them somebody's email address that you don't like and let them harass them for a while. It's just a mean thing to do. All right, so you can see we do have some bright ones on the agenda today. This is the anticipated impact. There are a number of them. On Bloomberg, we've got 5 things you need to know. This is something that you can sign up for. You don't need a Bloomberg subscription. Although, I mean, my month to month Bloomberg subscription is like $7. $7. So, it's kind of like why not have a subscription? So on the 5 things you need to know, they kind of rehash what came out yesterday. Give a little bit of an economy check. I caught this morning that Canada is going to look to also begin this year, and I think they ran a 25 point. You can see that if you go to the Live Squawk or the Bloomberg Twitter package. Just kind of scroll down into what happened. Should see Canada's post on there, or the Squawk, either one. You could go to Finance Juice. They always do a really good job of presenting that information as well. This market volatility that it talks about here in the Bloomberg 5 things you need to know, that's what we're going to be talking about in a few minutes when I said that we are priced in for a significant amount of volatility. The market seems to think that there is a big move coming. Now, of course, that can always end up being a dud, right? When everybody thinks there's going to be a big move, there often is no move at all. It's because if you think about it, when Corona hit, a lot of those firms were caught by surprise and they weren't carrying insurance. But since then, everybody's been on edge and everybody's been carrying a lot of insurance. Well, if your portfolio is protected and you don't have to sell anything because you're not going to get a margin call because you're carrying insurance, you're not going to sell anything. And if you don't sell anything and Joe don't sell anything and Sheila doesn't sell anything, then nobody's selling anything. Makes perfect sense. So we come over to Thinkorswim, we look at the market watch, go to the calendar. If your calendar is full and it's like this, and you're thinking there's just so much junk and you can't really see what it is you're trying to see, just hit the show all, turn everything off, and then turn on the Econo Day events. Now, I like to grab the description and set it next to the time. I just find that easier to read. 8:30, 10, 10:30, 11, 11:30, and 1 o'clock. And these events, these additional auctions, oh, they're game changers. Don't mistake this for a second to think that they're nothing that you need to be concerned with. I can't tell you how many times in a month they're on the dot right at 11 o'clock or right at 11:30 when one of these auctions hit. We see the indexes spike and just rip into a rally or drop like throwing a brick in the lake. Right on the second, 11:30, there she goes. It's one of the first things I teach new clients that come into my coaching place. Recognizing trend days and some of the triggers that go with it. These are one of those triggers. Additional auctions at lunch. You should be able to get a day done with the jobless claims. Just use that one for your trade and you're done and done. But these are what's on the agenda for today. So now we'll go over and take a look at the ES. It's the typical route that we take every morning when we're going through these. Now, the projected expected move last week for this week, and that's how we do it every week, right? On Fridays, we project next week's expected move. Well, last week, our expected move for this week was 42.54. I mean, we could turn the indicator on, but that's where it's at. All right. Well, right now, right at our current location, the ES has an expected move of $98. We'll just round up and say $100. That would take us to 44.32 or 42.32. But we're not done yet because there's a market maker move of an additional $70. That would put us at 40, what, 45 to the upside. So you can see how it gets very violent very fast. And this is priced for the next 2 days, that expected move that we're talking about. Well, here's a $170 drop or point drop, 41.64. So 41.64 to the downside would put us past that critical level of 4,200. This is where I get that information. Notice in the middle upper portion of the screen, there's an MMM. Now, there's not always an MMM, and it stands for market maker move. There's not always one up there. So sometimes you'll look up there and it's not there. And then other times it is. And it has to do with the front month volatility versus the back month volatility. And if you want to learn more about that, you can go to the Ticker Tape, which is a publication from TD Ameritrade, and search MMM, and you'll find like 40 articles to read, and you can get a real good in-depth understanding of the market maker move. But in the next 2 days, you can see it's got a $99.74 expected move. It actually changed since I wrote my notes. It's still increasing. Now, for those of you who don't understand much about options and volatility, this is a time-based measurement. And as time goes by, this number is supposed to shrink. Makes sense, right? We have every 5 minutes that goes by, we're closer to the end of the week. So how much time we have left is lower. The distance we could move should get lower. And yet, while I'm sitting here talking, it's still continuing to get bigger. They're not done pricing in the move. The move that they're expecting is getting bigger. So we're looking at a $170 expected move between this $72 now instead of 70. That one's gotten bigger as well. Instead of the 70 here, $100 here, and it's still growing. That's how you can price a right now expected move. Now, the formula to calculate this is a square root of time. So if you actually wanted to do a day by day expected move, you certainly could. I'm not going to nerd out on you guys today and walk you through that, but I've created a day by day expected move indicator. It's in the Discord. Nobody wants to deal with the square root of time at 7:30 in the morning. I mean, I'm a nerd, but I'm not that much of a nerd. All right, so the range is very clear, right? In just a second, somebody got lost. All right. So the range for the week. We've been maintaining it all week, waiting on the Fed. We finally got our Fed announcement. We're still sitting inside the box. We cannot maintain this forever, right? This will end. If you back up a little bit more and you start to get the perspective of this move to the downside, this is a very wide failed flag setup. It's it's not very clean, but it is there. So in the failed flag play, we generally look for 3 or 4, 5 days to the downside. We look for it to build this basing pattern, and then we look for the flag to fail. And the reason we call it a failed flag is because a flag is a continuation pattern. We expect price to continue. So if it doesn't continue, if it instead starts to build a basing pattern, then we say that the flag is starting to fail. Now, it has not failed yet. It would only actually be considered a fail once it comes back and reciprocates the other direction. But the longer it goes sideways, the more likely it is to fail. I say that, but we were long sideways here for a number of days before we finally broke and went lower. So, you know, generally speaking, we expect that sideways action to indicate the flag is beginning to fail, but it doesn't mean it has to fail. Still, we're looking at a prime example of a very large flag, and we cannot stay here. So we're going to be looking for any indication that we're going to reciprocate back up to these previous levels, which turns this entire pattern into a very large cup and handle, or we're going to look to break down through the other side and continue the move to the downside. We're in the middle of the box, so there's no edge in trying to anticipate which direction we're going to go. What we do want to be looking for is first touch plays, the first touch back to the high or the low. We are maintaining our Globex stance at the moment. So a break to the upside would have us challenging the highest Globex point. First touch play comes in there, which we should see no matter which way the job numbers go. We should see a touch of that high. Through that, we'll look to deal with yesterday's levels all the way up to and including the high of yesterday, these institutional pivot points. A break to the downside. We'll first look to challenge our own immediate low, then the low of the day. But before we get to that low of the day, you want to definitely make sure you mark out where we opened the day before, the Globex open, because that's also going to be a level. In fact, those two are close enough. You could probably get rid of our own Globex pivot here and just use the low from yesterday, or the Globex open from yesterday. There is a cog line at 42.11, 43.11, 44.11. Now, Thinkorswim's been having issues with the NASDAQ futures, and yesterday it was also the Russell futures. So I've had people reach out and ask, "Hey, what did you think of this really big gap?" Well, there's not a really big gap. You are seeing a lack of data, right? The broker doesn't have any information to put in there. So there's a gap. But there actually wasn't a gap. Price didn't close at one spot and then open up at another spot. That's not what happened. So for this morning, the same thing. You got the same range. We're going to have to resolve this range. We do have some critical levels. And look at the expected move in the next 2 days: $420 up, $420 down. Add to that another $305 for the market maker move, and you're looking at a $725 move higher or lower. Well, we're at 14,200. That would put us at 14,925 to the upside, or subtract 750 from the other end and take it to the downside. That would put us at 13.5 ish, right? Somewhere down around that area, right? So that's about a $725 move right there. When it comes to brokers having issues, don't just immediately run out and abandon your broker the first time it has a situation like this. I have over 15 brokers, and every one of them along the way wants to make changes and improve their platform, and try to bring in new things, and inevitably it always happens, they break something and they start having issues. It's happened to IBKR, Robinhood, Webull, Thinkorswim more than once, Tradeovate, Ninja. It happens to all of them sooner or later. So don't just immediately run out and abandon your broker as soon as it has issues for 2 days. But it's a really good idea to have a backup plan. I trade futures on Tradeovate, and my backup plan is Trading View because they link, and that's kind of my default backup for technical analysis too. Is if I can't use Thinkorswim to perform my analysis, I go to Trading View. That way you're prepared, because I live on my trading. I can't just call timeout and decide I'm not going to pay the bills next month. No, that doesn't work. So we really are looking to resolve this range. The range that we're looking at is very, very small compared to the size of the expected move on the ES and on the Nasdaq. So it's really just unlikely to believe that we're going to be able to maintain inside of this box for very much longer. And we've been talking about a capital rotation. If you go through and you look at the sectors, it's kind of hard to see what they're rotating into, right? So these are the 9 sectors that we would be looking at in the S&P on a day-to-day basis. If we're looking at a capital rotation, where are they going? So the only thing that I can parse out of that is, with the rise or the anticipated rise in interest rates, they're actually going into corporate bonds, right? Apple, X Steel, Facebook, those companies have bonds as well, not just stock. Well, we don't look at that, right? We look at stock prices. So it's very likely that that's the rotation that we're seeing, and we can't see it, right? They were also talking about pricing in a very aggressive Fed response. Like they were expecting a very aggressive Fed response, and they started pricing that in 2 weeks ago, and they didn't get it. They were much less hawkish than everybody had anticipated. This is the TNX and the TYX. It's a bond chart that I use. So this is the difference between these two. And you can see that we started to get jacked up yesterday afternoon. You take the same thing with the FVX, and the TNX. And again, same thing. And just look at the bonds, which is what I generally look at on a day to day basis. The 30-year bonds is what I keep up on my 5 grid. We're at this critical low. We kind of punched through it the other day, but we came back up. Now, I generally mark out areas in a zone, but if you were to just hit a line, that was very close to perfect. Talk about a critical line in the sand. We're there. We don't want to see this get retested and challenged again. If you were watching what was going on yesterday as the Fed was wrapping up, that move in the dollar yesterday afternoon, and the opposite move in the 30-year bond. Notice bonds and stocks, which is how they generally refer to the stock indexes, or like the Nasdaq, the S&P. They say stock, bonds, stocks, bonds. Stocks and bonds were getting trashed yesterday afternoon, and the dollar was bid up. The dollar was an accurate reflection of a global take on risk. The dollar and the VIX became very, very similar. Want to keep your eye on that too. Make sure that the dollar does decouple from the VIX. And we want to see this start to resolve itself, because right now the dollar and the bonds are continuing to move in lockstep together. A lot of people think that these are like a teeter totter on an inverse correlated level, that if the bonds go up, stocks have to go down. And as you can see here, that's not true. There's been periods in history, long periods in history, where these two were actually moving at the same pace in the same direction. Tasty Trades did some really good research on that. If you want to hit them up on YouTube, just type in something like Tasty Trades stock bond comparison or stock bond correlation. They did some really great research and a couple of really good videos. So it's not a surprise to see that these both can move in the same direction, but they haven't decoupled yet. So we had the start with that move yesterday when the bonds dropped, and so did our markets. They're all five now coming back up off of those lows together as well. One thing that was noteworthy is the bonds and the dollar closed at 3 o'clock yesterday. That's their general place. That's where they close, 3 o'clock. And generally, if they are the weight, the albatross holding down the market, then when they close, we see a change in market sentiment. Well, they closed and we didn't see much change in nothing. So, the big takeaway is continue to watch this dollar. If it starts to dump, you're going to see a serious impact in the market, uh, positively, hopefully, right? Considering on the rally up, it was knocking us down. Perhaps if it dumps down, it can let us rise back up again. Not going to say that's the way it will work, but look for an exaggerated move in the dollar. Keep your eye on it through the day. Let the bonds be a little bit of a guide, and keep track of the volatility in this thing. It's extreme. It's pretty nasty out there. Taking a look at the sectors, we do have a lot of sectors that are up, but not by very much, right? And my benchmark is they need to be up at least a half of a percent to even be considered slightly positive, or down a half of a percent to be considered negative. So we have a lot of sectors in the green, but just slightly. Financials less than half. A lot of them that are flat. EEM, which is what we use to track global risk on sentiment, is basically flat but slightly negative. And we should be seeing a lot of markets setting up for a red to green, considering how we went into the close yesterday. Now, I was actually talking with somebody yesterday about what our expectation was with the Fed. And I had made a comment that it would be very likely, since everybody was so hyped up about the response, it would be very likely, if nothing happened at all yesterday. And that's kind of what we got, a whole lot of running around and then nothing happened. And that it would take a good 24 hours while they wait for the nerds to digest everything and give them some forward guidance on where they should be moving their money. So we may start to see that follow through today, and it may actually take all the way till the end of the week and into the Monday session before we start to really see the results. And the Fed didn't make any changes yesterday. They pushed everything to March, which is not a surprise. We were expecting that anyways. But they're going to be coming out with the printed minutes. I believe it'll be next week, maybe two. But yesterday's press conference was just him kind of chipping his teeth and giving a broad outline of everything. At some point, they're going to be coming out with those minutes. And it'll be at that point that the market really starts to respond to what came out, right? Because there'll be some nuanced differences in those minutes that they publish. So, guys, for today, be careful, be safe, keep your eye on the volatility levels, watch the grids, and I will see you all tomorrow.